Hi, Alex. How are you? Can you hear me? Hold on. Let me check. Why? Okay. Um, can you hear me now? Okay. I can't hear you. Are you on mute? Let's see.
Oh wait, can you hear me now?
Yes.
I was on mute. I didn't realize it.
Okay. Awesome.
Can you hear like any like there's this like drilling sound? Can you hear that?
Okay, last time when you did, I knew what the issue was. Sorry, that was a new person who came on board, and that person messed up. Let me ask you: can you see the screen, like our PDF, right?
Well, I see right now. What I see is the GoToMeeting page.
Oh, okay. Let me change.
Yeah, I can see your mouse. Yep, I can see your cursor.
Can you see the PDF now?
Yeah.
Okay. I need to bring it here. Okay, and then I need to make sure I also need to bring it here. Okay. That's it. Okay. Is there a noise outside?
Can you hear it?
No, it is gone now. Okay.
Yeah. They're doing construction on the floor beneath us.
Okay.
So I don't know. It comes and goes. So hopefully it's not happening much.
Right. Okay. So thank you so much. Last year it was okay. Let me see. Can you see? Let me put it. Can you see the PDF now?
Yes.
Okay. Awesome. Let me make it like that. So it's
beautiful.
Okay. Can do it here. And I believe let me clean my desk. Okay, then we can. Okay, so I think you and me will be there. So I am not going to talk a lot. I'm just going to put you more questions regarding them, right? Everything. So
were you gonna have one of your colleagues do it too, or no?
No, she is not feeling well today. So out of the sudden, so she's not joining. She was supposed to, but she's not.
Okay.
So let's see, right? So this is just a main thing. So this is a main agenda. So for me, this is construction going on.
Yeah, you can hear it. Yeah, I'm sorry.
No, that is fine.
I mean, what I'll do is when you're talking, I'll just mute it.
Well, that could be a smart thing, but the point is sometimes you forgot to do that, right? So that's okay.
Yeah, I don't know what to do. I mean,
no, that is fine.
You go down there and tell them they have to stop until 3 o'clock, but I don't think they will.
True. So you are in your office building, right?
Yes.
Okay, awesome. So obviously these are easy things. I don't think so. We need to. You need any prep on that? Also, loss harvesting, right? These are the other consider, right? The annual balance. Any
I'm sorry?
Can you hear anything from your side? Any buzz?
Oh, as far as what's new? No, not really. People are starting to think about the tax cut sunsetting, but I know you have a slide on that later where you're talking about that a little bit. But as far as like what they're focusing on at year end, no, I think this is pretty good. PTET, tax selling, whatever. Yeah. So I guess just a question. Like, there's a lot of content here. It's really good. I mean, this year, did you work on it? Who put this together? Did you work on this, or it's pretty good?
Right. No, the last year content, and then we'll add some more content this week. So this part of it. Yes, I added some of those things.
Okay. Yeah, no, I thought it was good. I think it's a lot, right? So I think that, on these, sometimes, you might have to sort of, just talk about it in general. But like this slide, for example, I think you would say, many of you are familiar with regulated futures contracts. Generally, you get a 60/40 treatment. There's a lot of special rules here. Here are the relevant code sections. You almost like, I don't think you'll have time to, if we just think about it, I don't think you'll have time to do a ton of it, because an hour is not, a ton. Like if you have, we have 36 slides, right? So that's like less than 2 minutes a slide.
Right. And to be very frank, I just want to have more like a, how should I say, 30,000 feet, right? We don't need to go in the weeds.
Right.
Okay.
Yeah, so this one here, you're talking about the miscellaneous itemized deductions and how, so, what kind of jumps out at you is, 2025 is only 2 years away, right? So, I think people are starting to think about, like, what might the world look like? Like, is Congress going to just let the tax cuts expire? I think with our deficit situations, I wouldn't be surprised. I think I would almost assume that's the case. Maybe they'll extend some of these things for lower tax brackets and let them expire for the higher tax brackets. I don't really know. But, point being that, it's coming to an end under the current. So we can expect there to be, some tax changes, if not sooner, by the end of, year after next.
Right. True. Awesome. That was last year's slide you put together. If you want, I will delete. If you want to discuss a bit, that is fine.
I mean, I'm happy to talk about it, or we can delete it. If you're worried about time, you could chop it out.
Right. So yes, I was thinking is like, let's delete some of the slides.
Okay.
But okay, I will delete after that conversion. Let's go to all the slides first. Okay, so this is important, right? 988, 475.
Yeah. Yep. So if you're trading a lot of currencies, you want to do the 988. If you find yourself being stuck with wash sales and trials and all those other adjustments, and you're not going to get to long-term holding period anyway, and you have the potential for generating losses, ordinary makes a lot of sense.
No, but also at the same time, dollar was quite strong in the last couple of years, or at least last year, 2023. Is this election is annual election? Once you make it, you are stuck, because what I'm saying is this year, only if you're investing in foreign securities you would have loss. You might get a foreign ordinary loss versus capital loss.
On the 988, yeah. So like, yeah, no, that's not. So that's a contract by contract election. So like 475 is made on a.
Alex, sorry, you are mute. All of a sudden, I stopped working. Yes. No, you're back. No, you're back.
Yeah. Sorry, I have somebody trying to call through. Okay. Yeah. So 475 is like a trader business level or entity level. It's irrevocable, but there is a revenue procedure now where you can revoke it. But you should consider that sort of like a permanent election. There are some things you could go to if you want to remove it. The 988 A1B election is a contract by contract election. What a lot of people do, though, is they'll sort of institute a blanket like election that says we want this to apply to every future forward contract we enter into until we revoke it. But you're not stuck with it, right? So if you get into a situation where you feel that it's not beneficial to you, or you only want us to apply to certain contracts, like that's no problem. The 475 is more of a blanket situation.
Right. Okay. Awesome. the polling question we will ask. Yes, business meal directions only for 2023, self-employment and honor exception. What happened in the New Jersey market-based sources?
So they, I mean, market-based sourcing is something we have to worry about, in general, but effectively, states that are adopting this approach are saying that if you are a customer of a business that's providing services and you live in a state, that the revenue from that service is taxed to that state. So New Jersey adopted that approach mid-year and made it retroactive to January 1, 2023.
Mm-hmm.
And what that means is investment advisors that have residents that live in New Jersey and pay investment advisory fees should look at that revenue that they collect as New Jersey source and consider it for filing a New Jersey return. There's a number of states that have this approach: California, Connecticut. There's some states that are a question mark about whether it applies to investment advisory services, like Maryland is one that is not explicit, so some advisors file, some don't. But New Jersey for sure is, and the lesson here is to check with your tax advisor and make sure they're considering all the states. And everybody should be reviewing, as you collect your management fees, you can get this from your administrator usually, but you can get a breakdown of management fee revenue by state based on the residence of the investor. And then, almost look highest to lowest in terms of like, where's my greatest concentration of revenue by state residents, and then probably talk to your advisor. Like, we have one client that has like $3,000 in New Jersey, and they're gonna not file because it's gonna, they're gonna be showing like $800 of income to New Jersey. They're gonna just pass on it, but technically they should. So, I think that would be the way to approach it.
Okay. So let me go back again to the investment. What is QCBS?
Qualified small business stock. So if you acquire shares from a company original issue, like not from a secondary source, like if I own shares of like SpaceX and I sold them to you, it wouldn't qualify. But if you purchase stock directly from SpaceX and they meet certain qualifications and you hold the stock for 5 years, you can get an exclusion on the gain of that stock. There's a lot of sort of technical rules whether the company qualifies or not. There's a limit to the amount of gain that can be excluded. But essentially what you want to do as an investor is, if you're dealing in private equity, especially with like very early stage, there's a chance that the stock qualifies, and you should check with your advisor to see if that's the case. And it's a 5-year holding requirement. So these are the kind of things that like you want to sort of look into this on the front end when you get into each position. You say, is this QSBS eligible? And then just kind of keep an eye on it.
Right. Okay. I think next would be this one, same thing, right? These are just the prior year sheets.
These are the rules. Yeah, that's how much you can. Yeah.
Right. Let me clean some of these sheets. I'm going to delete some of the sheets. I think they copied from somewhere, so let me delete those.
Oh, you know what? It says Eisner Amper at the bottom. You probably think that.
So let me delete those, so then I can write.
Yeah, that's good. I didn't notice that earlier.
I just noticed also. I told them to use the prior one and make sure you're doing the letters right, so that I think. I think it will be very difficult.
I'm sorry.
What I'm saying is material is pretty much the same, right? I don't see any big issue there. I think let me clean this up a bit. So, is there? I think we didn't mention here, but I think beneficial ownership and latest rules on foreign tax credit on the you can
Yeah, is
affect
that?
that investment income tax.
Do you have the? I don't see it on the screen anymore. Are you still editing it or?
Sorry, yes, I was editing, but I can do that here. I'm
No,
going
no,
to.
I just yeah, okay. So we're gonna take you're gonna take out those, right?
Yes,
Those
yes,
yeah,
yeah.
okay.
Some of
So
the slides unnecessary. I'm going to take those out, right? Um, so right. So I'm doing right now. Um, so do you want to discuss qualified small business stock, or we can ignore that?
I'm sorry, say it again.
Do you want to discuss qualified small business stock, or we can ignore that?
We can keep it. It's up to you. I'm fine. I can yeah, whatever. Yeah, we can keep it or whatever.
Right. Okay. Okay. Distributions. I think now, after fixing this, now only 30 slides or 29 slides, right?
So if people start joining this early, will they just show up, or can you keep them out?
No, they will. They have to come at 2. Before they come, I don't think so. System will let them come in.
But it let me in because I'm a moderator, I guess.
Yes, exactly. And, sorry, you are working on. Okay, I think it is ready now. Okay.
You see there? Sorry, go back to that.
I'm just saving the new one. So
Okay. Looks like we needed a space between the words "to" and "the" on that one, but it's not a big deal. But I noticed it.
Let me know wherever you want me to change. I'm just opening it, right? So now I have less pages. Where do you want me to go and make a change?
Okay, so there's one in there that was the PTE. I noticed it was a typo. So keep going. Pass-through entity tax. Yeah.
This one?
Next page. Go to the next one.
Uh-huh.
Keep going. Keep going.
This one?
Do it again. Next one. Is that it? I thought I saw right there. To the, see where it says to the right before PT.
Which line? Sorry.
Applied. The right before 2 words before PTE that's highlighted yellow. See that?
Oh, to the. Okay. Got it. Okay. Let me make a change, and I was do that. To. Okay, so I'm going to save here, paste. Okay. So,
The one thing I'll say is that private placement stuff. I don't really know much about that. The private placement insurance.
We can delete. Which one is that?
There was a tab in there about private placement insurance being a tax planning strategy, but I don't. That's an estate planning thing. I don't know anything about that. So if you can talk about that, that's fine. But
okay. Let me. I have a 30,000 PPIL, right? It was a private placement insurance one. We did some work. Yeah, we can just delete that private placement. Page 26. That's the thing. Okay. Now?
Yep.
Okay, awesome. So let me go and update this handouts, right? So delete this, start and insert a new one. Okay. I'm just going to go for a quick restroom break. I will be back within a minute. Okay.
Yep.
Give me a second.
Sure.
I'm back. Sorry. Yes, we have 5 more minutes. Let's go one more time on the
Sure.
right. If there's anything here, everything looks good. Right. There's an, I don't know noise coming from my side or your side.
What's that?
There is a. Can you hear any noise from your side?
No, do you?
I hear from my side.
Let me mute it. Tell me if it goes away.
Right. I will also try to, if I hear those that not at this moment, sometimes come only for a minute or so and then it is gone, right?
What's it? What kind of noise is it?
That's it. That's it. Not the construction thing.
I don't hear anything.
Okay. Okay. So then it must be coming from my side. Let me.
Unless it's coming from me and it's going to, that would be my concern, right? Like, am I pumping it? When I muted it, did it get better or?
I think it is not coming all the time. It comes after 4 or 5 minutes for a second, then it is gone.
Okay. So are you, just to confirm, are you planning on, like, what are you gonna? I'm happy to do whichever, but just so we're not tripping over each other, are you gonna? You said you wanted to try to cover a lot of this, or?
Oh no, I would not try to cover it.
Oh, you want me to roll with it?
Right. I just want
Okay.
you to do the most of the heavy lifting. I will just add some question here and there to make it interesting conversation, but I will not.
Okay.
Okay.
What's on the legislative updates tab again?
Yeah. So if we can write this water sale and digital, and if you somehow beneficial ownership, you already know, right? Just the audit.
Yeah, that's fine.
Non-partnership audits are happening. Then obviously, wash sale and digital assets, right? That
Yeah.
these rules are getting implemented, right?
So what's the do you know what the wash sale digital? As it applies to digital assets.
Yes.
Gotcha.
Because right now it doesn't apply, but it's quite possible that
Got it. Okay.
they can apply, right? So only 2 minutes are left. I think within
Okay.
a few minutes we will just start the conversation.
Okay. How many people did we have last year?
Last year?
Yeah. The joint?
I think it was around 70 or 75, if I don't remember correctly. Right. So for me, it is more like for our YouTube channel, but also like more like for how should I say it? For our training purposes too, right?
Okay.
So I think within a couple of minutes we will start. I will do some housekeeping items and then we'll go from there.
Yeah, and if you want to open it up to like questions from people, like I'm happy to field questions too.
Yeah. So we will definitely leave it there.
Okay.
Any of the things. So we have a minute left, and I will just start the button. I will let you know when I start.
Okay.
I'm going to start. Hedge fund data and tax strategies webinar. Today, data and tax strategies. There are Alex coming is here along with me, so we will try to. So I will let Alex.
Hey everyone. My name's Alex, as Mohammed already introduced. I'm with Acadia Family Office. I've been here for about 7 years. Prior to that, I was with a regional mid-sized firm in Maryland that focused almost exclusively on the hedge fund space. And I have about 25 years of working on hedge funds, advisors, GP entities, and similar things. So hopefully at the end of this hour, I've been able to provide you guys with some good useful information. Thank you for joining, and we're open to questions throughout. I think Mohammed's going to pause at various points to allow the opportunity to ask questions.
Yeah. Thank you. Please feel free to ask any questions, and just a couple of housekeeping items. You will get the CP if you answer 3 out of 4 polling questions, and we are registered with NASPA, and at the next couple of days we will issue the certificates to the people who are answering 3 out of 4 questions.
Okay, great.
Go ahead, Alex.
So one of the things that we like to talk about with our clients this time of year is what to think about at year end in terms of ensuring that we don't have any nasty tax surprises. So generally what we try to do is to look at how the tax gains and losses relate back to the book. So one way to have a unhappy surprise for all the investors is to have taxable income that's greater than book. Sometimes there's not much you can do about that, but just in terms of having an opportunity to do some planning, or if nothing else, provide an estimate to the investors. It would be good to work with your tax advisors to review sort of the taxable income year to date as it compares to book. You're looking for unrealized losses that might not be realized or any sort of tax adjustments, which we're going to go into next. Primarily, the biggest one that catches people is if you've traded in and out of a stock and you have a loss. So if you're somebody that has a higher turnover, anything is treated as a capital asset, stocks, options, bonds, and so on. If you realize that loss and you reacquire the position within 30 days, either 30 days after the sale or prior to the sale, you're going to have to take that loss and roll it into the basis of the position, meaning that it's temporarily disallowed. So one of the things that would be good to do is to review at your end or close to your end how many positions that you traded throughout the year that you required within 30 days and what's the accumulated loss. Most administrators or advisors, tax advisors, can help you run this report, and that's something to take a look at. If you find that you have positions that have accumulated realized wash sales, what you're going to want to do is try to close out of that position for at least 30 days. Even if you sold it before year end, say December 29th, as long as you stay out of that for 30 days going into the new year, you're going to get to realize that loss from a tax perspective. One of the problems with this is being out of the position. Sometimes these are things that need to be part of the portfolio. So you can get around that using some of these strategies that are listed here, the basket swap, doubling down, or option to trade around it. Other things that can be done would be trading in a security that is similar or represents a similar opportunity in the market. Another adjustment, it's a bit more complex, is a straddle. So this is where we have, often you see it with like a put option. If you're long on a put and long on a stock, that put option is there to protect you in a lowering of the price. When those expire, typically you'll take a loss. If you have an unrealized gain in a position, at year end, the loss recognized on that hedge position is going to be temporarily disallowed as well. We tend to see larger magnitude of dollars being suspended with wash sales, but straddles can also be an issue, so that would be another thing to check with your advisors on.
Awesome. Thank you, Alex. So let's continue the conversation regarding loss harvest.
So the prior slide, we sort of talked about like traps or pitfalls that you could fall into. Loss harvesting is an opportunity to free up some unrealized losses. So the other thing to look at when you're reviewing your book to tax analysis is if you have book losses that are unrealized. So we're holding on to a position, we think it's a winner, it's going to be a winner long term, but at year end we're sitting on a substantial unrealized loss. That's an opportunity to trade out of that. As we just learned on the prior tab, you have to be out of it for at least 30 days. So it would require some strategy. As it states here, we have to beware of the wash sale rules. Ideally, from an ordering perspective, it tends to make sense to focus on your short-term unrealized losses first. If you're recognizing a loss and it's short-term, that has a lower chance of offsetting other long-term gains you might have in the portfolio. If you recognize a loss that is long-term, it's going to first offset any long-term gains that partner might have in their portfolio. So from an efficiency perspective, it's better to try to do it before it gets to long-term. Sometimes we see clients not selling positions that already got to the long-term mark, and they might only focus on the short-term loss potential. The other thing to think about, however, is if you think it's going to be a winner long-term, and you think you might come out of that unrealized loss position, if you close out of it and enter back into it 31 days later, you've reset your holding period. So just to go through a quick example, let's say you were down on a position 20% and you had held it for 8 months, and then Q2 of the next year, things turn around and you're actually up on it. If you sold it at year end, you'd only have a holding period of 5 or 6 months, let's say. And if you had just carried that unrealized loss all throughout the year, you'd be over 12 months, and then it would be a long-term gain. So the challenge with this particular strategy is sort of anticipating what might happen after you sell it.
Awesome. Thank you, Alex. So would you like to touch some on constructive sales, worthless securities, on such a short positions at the year end?
Sure. So in order for a covered short to be realized for the year, it actually has to settle. So realized gains and losses are typically trade date. So if you're long a position and you close it and you trade it December 29th, you should be able to get that realized gain for that year, even if the security doesn't settle until the first week of the new year. With a short position, to close it from a tax perspective, that it actually has to settle. So shorts are closed with delivering the underlying security to offset that borrowed stock. So to have that be a realized event in December, you have to make sure that you allow yourself enough time for it to settle. Constructive sale is a situation where, let's say you're long a position, you have an unrealized gain. If you enter into a short to hedge it, that's going to be triggered as a realized gain, even though you haven't actually sold your long position. The reason for that is the constructive sale rule says that you've effectively sold that position, you've got receipt of the cash for the underlying, and that's going to be a realized gain or loss. For worthless security, you have to abandon the security. If it is worthless and you can prove it and you abandon that security, it's going to be a sale or exchange on the last day of the year. That's something that you should document and discuss with your advisor to make sure that you get that treatment. Sometimes you have to take some definitive action to document that you're abandoning it. So that's something to discuss with the advisor prior to the year-end closing. And then the other thing to think about is, and we're going to get into this a little bit later when we talk about portfolio deductions, but are you a trader or an investor for the year? The tax treatment of the expenses is different. If you meet the trader status, your operating expenses, management fees that you pay, any fees to an advisor for an audit or a tax return, all those expenses will be ordinary and offset against other ordinary income with no limit, even though you're not materially participating. If you're an investor, those expenses will be portfolio, and under current tax rules, they're going to be non-deductible. So getting to trader status can be very beneficial. It's a facts and circumstances determination. There's no bright line test. It's been tried in a number of court cases, and in general, you need to have operating in such a way that you're holding things very short term. You're not holding things for long-term capital appreciation. You have substantial turnover of your portfolio, and in general, you're just turning it over. Some of the guidance in the court cases that are out there looked at criteria like how many days of the year are you actively trading, suggesting that you needed to be trading for more than half of the actual days you could trade, and how much of your portfolio did you turn over. Sometimes we see people that have a balance sheet that is long biased and buy and hold biased, and then they have a small portion of their assets where they're actively trading, and they try to get to trader. You have to sort of take a step back and look at it. You know, if the IRS comes in and you're selected for audit, or even goes to tax court, and they see that 90% of your balance sheet is in assets that you hold for 3 to 5 years and only 10% is traded every day, they might take issue with that. The reason that this is meaningful is it can change from year to year. It is an annual test. So if you're somebody that strategy could change depending on the environment, and that includes the volume and frequency of turnover, it's something to keep an eye
on. Awesome. Thank you. It's time for the first polling questions. Let's do that.
Basically, no change. And this
We've closed the poll. Let's go to the next one. Okay,
so now we're getting into some of the financial products that have beneficial tax treatment. So many of you on this call are probably familiar with Section 1256. These are your regulated futures contracts. They have 60-40 tax treatment, meaning that 60% of the gain is going to be taxed at the long-term capital gain rates and 40% will be taxed at the short-term capital gain rates, regardless of how long the position was open. You could be in and out of this contract within the same day and still get 60-40 treatment. The other characteristic about 1256 contracts is they're marked to market for tax purposes, meaning that any unrealized gain or loss at year end is going to be treated as taxed, regardless of whether the position is open or closed. Sort of think of this as whatever your year-to-date book income is on that position is going to be taxable income at that 60-40 rate. These are capital gains and losses for sort of all purposes. So once it hits your individual return, it's going to get cut up 60% long-term, 40% short-term, and then flow to your Schedule D and be handled like any other long-term or short-term gain or loss, including netting with other losses that you may have or capital loss carryovers. At the top of this bullet here, it lists out the code sections and the subsections, describes which assets are subject to this treatment. It's fairly complex, but most of your regulated futures contracts are sort of readily known, and some of these other sections apply to other things that are also in the financial product space. Listed at the bottom here is one notable exception. So if you have a foreign currency contract that is not a regulated futures contract, it's subject to the mark-to-market provisions of 1256, but instead of being treated as a capital asset, it's ordinary gain or loss. So this applies to, let's say, a forward contract between, say, the US dollar and the euro, unless we make a tax election, which we're going to talk about later.
All right. Thank you. Yes.
So we touched on it earlier about trader versus investor. So miscellaneous itemized deduction is what's going to capture your investment expenses if you are an investor fund. So this was somebody that was not sort of trading every day or almost every day. This is going to apply to your private equity funds, your buy and hold funds, a lot of fixed income funds. You're simply not going to have that volume of activity that's going to allow you to get to trader status, meaning management fees, expenses, audit fees, administrator fees, legal fees, all those things that are being charged against your account are going to be a miscellaneous itemized deduction. Currently, and it's been this way since 2018, they're simply non-deductible for an individual. Prior to that, it was known as a 2% miscellaneous itemized deduction, meaning that to the extent that you had miscellaneous itemized deductions that exceeded 2% of your adjusted gross income, you do get to deduct them. That seems like a relatively high hurdle to hit, but what we saw after this tax law change is that there were a lot of investors that were able to benefit from some of the expenses that exceeded 2%. So this rule, when it came out, I think the perception amongst the industry was it wasn't going to have that big of an impact, given that that 2% hurdle is hard to get to anyway, but it absolutely did. So the trader investor determination has a bigger impact than it did. Of note, you'll see here that it's to 2025. As we're getting to head into 24, it's a lot. It's sort of right around the corner that this would sunset. What a lot of people are starting to talk about is what might happen with the TJCA. Most of the provisions are generally set to sunset at the end of 2025, including our marginal tax rates going back up to what they were prior, the larger standard deduction, the cap on $10,000 of state taxes paid, all those things, provided there's no action taken by Congress, will go back into effect. It'll be good for certain taxpayers and bad for others. Probably the biggest benefit to the investor community is the SALT cap sort of going away, because that hurt a lot of folks, especially in high tax state jurisdictions. It'll be interesting to see what happens with this. Usually when there's tax cuts that are put into place, there is some legislative action to try to harvest or keep some of them once they set to expire. So it's a little too early to say. We have an election that will happen between now and then. So everybody's kind of keeping their eye on that.
Thank you. So this is another tax planning tool.
So for people that are in an investor status, especially in a family office setting, which is where you sort of have substantial wealth, you're having a family that's managing it for the current generation and future generations, you tend to see more investments or more of the balance sheet being held in things that are investor rather than trader. And that compounds the problem of having significant expenses which are non-deductible. So there are two strategies that can help with that. If you can hold your investments through a PFIC, which is a passive foreign investment company, often if you think of anybody that's an investor in an onshore hedge fund, you may note that it's invested in a master fund, and they may have an offshore fund equivalent, which is typically a Cayman corporation. Mm-hmm. Those offshore investments are generally for tax-exempt U.S. persons that are avoiding UBTI and non-U.S. persons. However, if that fund is willing to let you invest through that offshore and they're willing to provide something known as the PFIC statement, sort of think of it as like a 1099 for an offshore fund, then you can get similar tax treatment from the good assets from the fund, which is long-term gains pass through, and you are able to deduct or effectively offset any expenses which otherwise would be non-deductible, miscellaneous itemized deductions that would have flown through the onshore fund on that K1. They do net with your ordinary income in the PFIC. So what this does is it allows you to use those expenses. There's definitely some downsides to PFICs, especially if you are in a loss situation, but it's worth looking at. The other option here, family office structures, is much more sort of significant, and it's a major kind of structuring initiative that's done with families that again are sort of managing current generational and future generational wealth. And what this involves is forming a management company that is being paid by the funds or investors, which is really again the family members, through an allocation of income. And then that management company files a corporate tax return. They report the sort of that carry or that reimbursement for providing services as ordinary income, and they're able to offset their expenses fully. There's no portfolio deduction concept. So if you take a step back, let's say you have a family that has $200 million of assets under management. If it costs them, say, $4 or $5 million to sort of run those assets in terms of all advisory fees and overhead, management fees, et cetera, if they charge an incentive allocation from funds that they structure for the family of, say, $6 million, they're going to be able to fully offset that $4 or $5 million load against that. And that remaining income often is sort of assigned to a trust or some family members that may be instrumental in managing the assets. So that's a very involved structure. Typically, you work very closely with estate planning attorneys and advisors that specialize in that space.
Awesome, thank you. Yes, these are the two elections mostly involved the hedge funds 988 and 475. Can you please shed some light on this?
Sure. So we talked about some tax adjustments that we see that is good to be mindful of at your end. If you have a lot of wash sales or straddles and you're definitely a trader, the 475 election can be very helpful. This allows you to take whatever activity which is generating a lot of these tax adjustments and place it either in a vehicle or an account that you make the selection, and that takes all of those assets and subjects them to a mark-to-market regime, meaning that all unrealized gains or losses are treated as realized for tax purposes at your end. There's no tax adjustments for timing, such as straddle adjustments or wash sale adjustments, and it's all ordinary income or loss. So the benefit to this is if you were having tax greater than book due to a wash sale or straddle adjustment, and you were only generating short-term capital gains anyway because the portfolio had a very short holding period or very rapid turnover, you're going to eliminate those tax adjustments, and the income will be ordinary. So if it's a gain, short-term and ordinary have the same tax rate. But if it's a loss, your capital losses are subject to limitations, or they'll offset other gains, including long-term gains, which have a preferential rate. So the benefit to that is if there does happen to be a loss year, it's an ordinary loss, which is not limited. So that's very helpful to a portfolio that's got rapid turnover and also for short-term holdings and exposure to wash sales and straddles. The downside is you're foregoing any long-term potential. And the election, once made, is difficult to get out of. It used to be irrevocable. There is a revenue procedure now where you can go through steps to have that eliminated, but it tends to make sense to really make sure that it's an appropriate election for the strategy, long-term and short-term. The other election here, which also alludes back to a prior section that we looked at, when we were talking about Section 1256 and how it impacted forward contracts, the way that it impacted forward contracts is it was ordinary income but mark to market. If we make a Section 988 N1B election on those contracts, we get to have them treated as a 1256 contract, not only for timing but also for character. So that means it'll be treated just like any other regulated futures contract, and 60% of the gains will be long-term and 40% will be short-term. It's important to note that this applies to cross-currency forwards that are on major currencies, and think of these, they would have a Section 1256 future currency equivalent. So if you see a futures contract that you can trade on CBOT or any of the NYMEX or any of the regulated exchanges that's cross-currency, if you're holding a forward in that same currency pair, you'll get to make this election and have it give you that treatment. So it tends to not apply to a more obscure currency, but most of your major, think of your major currency pairs, it should apply. The interesting thing about this election is a contract by contract election. It needs to be made in advance of entering into the contract, and it doesn't go beyond any other contract. So if you made it on a contract that you put on today, but you put on a similar trade tomorrow, but you did not make the election, it's only going to apply to the contract you put on. From a practical perspective, it's very difficult to sort of track these things. But what we see is people tend to make blanket elections. So if you say, I've got this basket of forwards that I'm trading in this account out of this trader, generally we expect these things to not be part of hedges. It's a for-profit trading program. We think of the long term, we're going to make money. And I'd love to get 60-40 treatment, getting long-term capital gains to at least a portion of it, instead of ordinary income, which is a higher tax rate. I'm going to go ahead and make this election. The way that you would do that is put a statement in the books and records of the corporation, reach out to the broker and indicate that you are invoking Section 981B for every contract entered into in that account from whatever date forward until revoked. There is no form filed with the IRS. It's something that you're just supposed to communicate to your broker and put in your books and records. We have seen where people have tried to do this and they speak with a broker and they're not sure how to do that, and the broker doesn't know what they're talking about. So we tend to just put it on the company letterhead, send it to them, sign it, date it, have them acknowledge receipt, and that's kind of your proof that you've been able to do that.
So just Alex, if you can shed some light, even when the taxpayer made 475 election, they can still hold securities for long-term capital gain.
So if they make that election, they have long-term capital gain. What should they do about that? Or
means even if you make 475 election, you can still buy and hold portfolio.
Oh yes, yeah. So let's say you're a multi-strategy advisor and you have a basket of activities that you know is going to be sort of short-term. You're not going to hold it long-term. You have a lot of watch sales, and you want to make the 475 election. Yet you have other assets that you trade, and you're expecting that to generate unrealized gains and losses and long-term gains. So the way to do that is, instead of making the 475 election on the entire entity or the entire portfolio, you can establish that when you make the election, and I should have said, the manner for making the election is you include a statement in the company's or the entity's books and records the day that you want it to be effective, and file a copy of that with the first return that's filed. And you identify in that statement, in that election, what trade or business it applies to. So practitioners have sort of looked at that and decided that it's appropriate or reasonable to, you could have more than one sort of trade or business or more than one activity within a fund or even an individual's account if you're trading a lot of things that you say is a trade or business that you'd like this to apply to. So to sort of segregate that activity, you need to be able to very clearly show which trades or which activity is subject to it. And a good way to do that would be to, let's say, have a separate brokerage account or sub account that you say, everything in account number, XYZ 1006 is subject to this election. Or, some people even will create a disregarded entity, a single member LLC to hold that activity and make the election. And then make sure that the accounting and the books and records provided by the administrator, has the clarity to clearly trace and track those positions. And then, everything outside of that should be sort of free and clear from being subject to 475. I think you're muted, Mohammed.
Thank you. Time for next polling question. Let me watch. Yes, Alex, this is a polling question.
Okay, so what we've talked about so far has really applied to an individual investor's portfolio or an investment fund, hedge fund, and so on. Some things to be concerned about. So over to the owner side of the ledger, for anybody that's here that works for a fund or is an owner or manager. Let's talk about some of the things that impact your management company. One thing to note for depreciation. So one of the provisions of the TJCA is bonus depreciation, which starting in 2018 and all the way through 2022 was 100%, meaning that if you had an asset that you were placing in service that had a useful life of 15 years or less, and you placing in service, you'd automatically be eligible for 100% expensing of that under a bonus depreciation regime. That is dropping to 80% for 2023. A lot of people have sort of gotten accustomed to the ability to deduct 100% of things that they place in service. So this is a little bit of a switch. The way that it would work now is, let's say you had a leasehold improvement. Let's say you built that new office space and you spent $2 million on the new build out. In 2022, if you did that, all $2 million would be allowed as a bonus depreciation expense. For 23, 80% or 1.6 million would be allowed, and then the remaining 400,000 would be depreciated over the normal useful life of that asset, which for a leasehold improvement, let's say it's qualified leasehold improvement, it's 15 years, and that would be straight line. So you'd get 1/15 of that build out, and then it would take 14 more years to get the remainder. Couple things to think about with bonus depreciation is depending what states you're filing in and their rules. Many states do not couple with that federal deduction. Typically, when there is a tax law change, most states say that taxable income starts with federal taxable income, and then they have adjustments or additions or subtractions depending on their own state rules. So when there's a tax law change, there's sort of this like waiting period to see if there's a state that you're filing in. Let's say it's New York. When is the New York legislature going to rule on that, and are they going to adopt it fully so that the state takes the same position? With bonus depreciation in particular, just by way of example, New York does not conform. What that means is if you have bonus depreciation flowing through your federal return, and let's use that same example. We're gonna bonus 1.6 million in 2023. $1.6 million will be an add back for New York, and then it'll be depreciated over the same 15-year useful life for New York purposes. So, 1/15 of 1.6 million. Let's just round it to 100,000 thereabouts. So you're gonna have, let's say, $1.5 million higher income in New York for New York State purposes than you did for federal, and not having that visibility or understanding can sort of lead to a nasty tax surprise for state purposes. Oftentimes the owners of the management company kind of get a federal tax estimate and assume it's the same for states. Well, this is one case where it's not the case. We've also seen that be a real big issue with real estate partnerships. So if you're an investor that lives in New York even, and you put money into a fund that's going to run a real estate portfolio, and they incur a lot of rehab costs that are leasehold improvements, you might have a massive loss for federal purposes from that investment, and a gain from states. So that could be definitely a surprise. So what do you do about that? Well, there are some other provisions that allow you to deduct these things. There's something known as a Section 179 expense, which has a limit to the amount. I think for 22 it was $1,080,000. It, I think, ratcheted up to $1,123,000. And effectively, what this allows you to do is the first assets placed in service up into that threshold can be Section 179 expensed, meaning same tax treatment. You get to write it off your return. But the difference is many more states elected to conform to Section 179. It's an pretty old tax provision. I've been doing this since late 90s, and it was an expense then. It hasn't changed since, other than the amounts are going up, periodically per year for inflation. So one strategy here is, if you're used to bonus depreciation and it's getting cut back to 80% for 23, one thing to consider is, could you just Section 179 this? And that could allow you to just get the entire deduction from a federal and potentially state perspective, depending on the rules. One interesting thing of note is that bonus depreciation, the way that it was written in, is it's a default election, meaning that you have to opt out. So just to sort of pay close attention and work with your advisor, if you're placing assets in service, it'd be a good question to ask. Hey, are we using bonus here, and have we considered whether it makes more sense to utilize Section 179? So that's just one update for this year for depreciation specifically. The next one is business meals. Historically, business meals have been a 50% deduction, meaning that any meal expense, whether sort of pantry for your office where you have snacks and sodas and things like that for guests and employees, or it might be a lunch with an advisor, or dinner with an important client, that was generally always a 50% deduction, meaning half of it was non-deductible. For 2021 and 2022, this was increased to 100% for any meals that were purchased at a restaurant, which was meant to be a stimulative factor. Many restaurants were impaired with the COVID pandemic, so that was an attempt to sort of help restaurants get back on their feet. Well, that sunset in 22, there's 2 years, so we're back to the 50% treatment. In there are just other things to think about that are similar to that. If it's an entertainment expense, it's not deductible at all. So what does this mean? And this is a change. It used to be meals and entertainment were 50%. So let's say you took a client to a Knicks game, and it was a business purpose. It was a business meeting. They were in town. You could deduct the ticket. You could deduct the dinner that you had before the game, beverages you had at the game, and it was all subject to 50%. Now, under the new rules, the cost of that ticket would be non-deductible, but the meal beforehand and beverages would still fall under the 50% deduction. So it's important to track expenses a little bit better and understand that treatment. The last thing on this point, if you have a firm function that's for like team building, like let's say a holiday party, or you take, even it doesn't have to be the entire firm. You could have a manager take a protege to Top Golf for an afternoon and have a team building sort of experience. That's fully deductible. Again, with all these expenses, it's important to remember that it's a business expense if it's related to the primary course of the business, and it's necessary and ordinary. These are very subjective terms. I think necessary, like why is team building deductible? Well, we all know how hard it is to get good people and keep them. So we want to make sure we have a good, healthy work environment. People feel valued and trusted, and give them opportunities to build relationships with their coworkers. So that's why that would be a necessary expense. And ordinary is, it makes sense for what it is. Again, an afternoon at Top Golf and $100 or a few $100s, totally reasonable. If it was a trip to the Bahamas, that might not be considered an ordinary expense. So subjective, but I think most of us would know sort of what that might mean for what's normal for the industry and for the level of personnel and so on.
Alex, I have received a question here. They're saying if the employer provides the lunch to the employees, are they fully deductible or will be subject to deduction?
If it's lunch for an employee, unfortunately, that falls under the 50% rule. And there's a lot of folks, especially let's say a trader. Let's say you have guys that are stuck at their desk trading and they don't want to take a lunch, or they come to work or they stay late. They're trading overseas markets and they're working late. We're going to provide dinner, even though there's a very good business reason for doing that. It's still a 50% deduction.
Okay. So this won't consider under fringe benefits where you can deduct 100%?
Like a per diem?
Yeah.
Yeah, so per diem, that's a good question. There are very specific fringe benefit rules. So let's say somebody's traveling and they're going to, you're based in New York and they're going to a conference in Florida. You can provide a per diem, and that's not taxable to the employee, and it's fully deductible, and it's not a meals and expense. There are sort of kind of set rules about guidelines for what those amounts are. I think you have to have a firm policy and so on, but they tend to be, a per diem might be $40 or $50 a day. If you said, just go out to lunch and dinner and submit your receipts, that would be subject to the 50%.
Okay, thank you.
Sure. Let's see. Also on here, for folks that are in the structuring phase and are getting a K-1 from a management company, if you can form that management company with a limited partnership, it provides an opportunity to do some tax planning to mitigate self-employment taxes or net investment income taxes you're paying. Under current IRS guidance, a limited partner that's actively engaged in the business is not generate self-employment income, and it's not net investment income. It's a little bit of a, I don't want to say loophole, but sort of narrow window where these things are overlapping, and based on the current sort of rulings, you still need to pay that person a reasonable guaranteed payment, but any earnings that they might get that flow to them should be exempt from this. Just a key point here, and this is what we really see most, if not all, management companies are being formed this way. The issue is the IRS seems to be challenging it in certain cases. There's a few cases out there that you could Google and find very large companies that are being taken to tax court for this, and they're fighting back because they feel that they have 100% position for doing it. So it'll be interesting to see. They're, to my understanding, being litigated currently, so I don't know how long these things might take, but I would think within the next 12 months we'll be able to read a tax court on sort of what happened here. This is one of those things, kind of like carried interest, that's talked about a lot in terms of an opportunity for Congress to try to shut down what they deem to be a loophole, but under current guidance, it's totally fine. It would be important to speak with your advisors to make sure that you think the guaranteed payments that you are paying self-employment income on are appropriate. you wouldn't want to have, let's say, let's say a partner that was a 20-year veteran of the industry, get a guaranteed payment of say $60,000 and only pay taxes on that, and have $1.5 million go to him on his K1 for an LP. IRS certainly is going to challenge that. So you need to have sort of a significant guaranteed payment, and it's anything over and above that. The thinking here is that this LP interest is sort of no different. It's like your investment capital in the company, and you're being paid your guaranteed payment to do your job, and that's why it should sort of escape this treatment. Effectively, we're probably looking at the 3.8% sort of tax rate. Think of it around 4%. In that, you pay your SE tax on I think the limit's 100 and what it is for this year, 160 something, 160,800 or something like that for 23. Anything above and beyond that is just subject to your Medicare or NII sort of rate. So that's again that 3.8% if you're over 250,000 as an individual. So it saves about 4% on whatever you're able to push to your K1 outside of your guaranteed payment. Next, probably everyone here has heard of PTET. This is workarounds that states have sort of added to their regime, where you can file a return and make an election to enter into this regime. It allows that partnership, that entity, the pass-through entity, to be subject to tax on the income in that state. That creates a federal deduction, which lowers your U.S. income, and whatever amount of that tax that is paid at the entity level becomes a credit to you. So just a quick example, let's say you're based in New York, you're a New York State and New York City resident. I'm going to use round numbers here. Let's say the tax rate between state and city is 14%. If you make $1 million, that's a $140,000 tax burden for city and state. If you make a New York PTET election and pay that $140,000 through that partnership entity, it's going to lower your federal income from $1 million to $860,000. And let's say you're 37% tax rate, you're going to save 37% of $140,000 from a federal perspective. So, call it $40,000 or thereabouts. You'll save about $40,000 in federal tax. On the New York side, that $140,000 is paid in, just becomes a credit on your New York State, New York City returns, and you pay the same 14%. You don't get to deduct it from city and state, but you get to lower your federal tax. So most of these, if you have the ability to do PTET, it's sort of a no-brainer. It allows you to save 37% of every dollar that you pay in. It is an added compliance. There's quarterly estimates and some other things, so there is an annual cost to it. But with states sort of having a wider reach now on what they deem to be source income, and there being income in multiple states, it can really help. We have a lot of clients that consider whether it makes sense to form a holdings entity. So if you're married, so you and your wife form a investment partnership and you kind of put all your assets into it, you live in a PTET state, you can make the selection, pay taxes to that entity, and deduct your state taxes. The IRS is threatening to write regulations on this. So far, they've just put a ruling out that says on a current law it works. Many people are doing it. There are some questions and some risk that they could come out with some guidance that changes this, but as of right now, it's being done widely. As we talked about earlier, the tax cuts expiring in 25 could have a material impact on this, because if it goes back to you're allowed to deduct your state taxes, you won't have the need of PTET anymore. Last point, related to management companies, New Jersey market-based sourcing. Early this year, I think in the summer, New Jersey published guidance that indicated that they were adopting market-based sourcing as it relates to investment advisory fees. So just to give a little bit of background here, if you sell products into another state or conduct a business in that state as a business, that state's going to want you to file a tax return. Traditional apportionment factors are things like sales, rent, salaries, and things like that. So think of a business based in New York, but they have, let's say, an office in New Jersey, and you pay rent in New Jersey, and you have 5 employees in New Jersey. Those are things that you're going to proportionally assigned to New Jersey, and that there's a weighting calc that takes a percentage of your income and says, hey, that's New Jersey source income. Many states are moving to a model of it's called market-based sourcing, where instead of the traditional factors, they're saying, look, we're going to just look at sales, and we're going to consider where the consumer resides. And in a service business, if you're selling a product like, let's say, a restaurant, it's easy. Like, how many sales did I have in that restaurant in that state? But if you're providing a service, like in, let's say, you're a cell phone provider, a cell phone, how many dollars did I collect from somebody that paid their cell phone bill in New Jersey? Well, if you're an investment advisor, you're providing a service that is being paid. So if you have an investor in New Jersey that pays you $10,000 in management fees, under this new rule for 2023, you have $10,000 of sales in New Jersey. There's a number of other states that have similar provisions. The challenge with this is figuring out which states have explicitly identified investment advisory services as being a service that's covered, and other ones where you're left to interpret it for yourself. Connecticut, California, New Jersey, Tennessee, off the top of my head, are the ones that have explicitly identified. If you have investors that reside in those states, you need to consider that revenue as a possible return requirement. Other states that have market-based sourcing but haven't explicitly identified whether or not it applies to investment advisory services would be a state like Maryland, where I'm from. And we're seeing clients kind of weigh, how to decide where to file. It becomes an immense compliance burden if it's every state, as you could imagine. So what I would recommend is check with your advisor, talk to your administrator or your controller, CFO, and see if you can identify the revenue collected from each state resident and sort of go from the highest number to the lowest and work your way down. Even if you have, let's say you had $3,000 of revenue from a New Jersey resident, and by the time you did the math, it amounted, that just means that you have that as apportionment. That's not net income, right? So you have all your expenses offset and so on. Let's say on that $300,000 of revenue, after deducting expenses and everything else, it's $800 of income. Technically, there's a requirement to file a New Jersey return, but for $800 of income, a lot of people might elect to pass on that. So, it's determining whether you have exposure and then what's your position for filing.
Right. Yes, and time for next polling question. I'm launching this. Okay.
So we touched on PTAT a little bit earlier. Some more points here. I think we're running a little short on time, so I would just encourage anyone that had any questions to please write in on this. Another thing to consider: excess business losses. This is something that is going to sunset in a few years. You're limited to, this applies really more to your management company, but could impact you if you're invested in a trader fund. You're going to be limited to deducting $500,000 as a married couple. I guess, it's gone up to 540 now. Married, filing joint, and anything over and above that is going to be a carryover to the next year. You will get it. It'll become a net OL.
Another polling question. So, Yes, this is the legislative update, what is happening at the Congress and Senate, but also what IRS is doing. So Alex, please get some light.
Yeah, so we have this prospect for tax package before year end. It's very difficult to say. It's an odd time politically. There's a lot of sort of things going on. You tend to have a little bit more chatter about policy and procedure, but it just seems like legislatively there's more important things going on. So I wouldn't be surprised if not much happens. But there's been discussions about restoring expensing of R&D, permanently expanding the bonus depreciation to 100%. And then adjusting the interest expense deduction limitation. This probably also largely has to do with the rules that came as part of the TJCA, which has limited business interest expense. Other things to think about, and this is maybe more likely, digital assets are here to stay. There's not a ton of guidance out there currently under the guidance. It's not considered a security subject to the wash sale provisions. So that 30-day holding period requirement to be able to recognize a loss does not apply to digital currency or related products under the laws that's currently written. So consider that if you're looking at your year-end selling. I wouldn't be surprised to see legislation on digital assets. This next one is definitely something to talk to your chief compliance officer or attorneys about. It's generally not being handled by public accounting firms. There's some questions as to whether it's even appropriate for a CPA if they're licensed or could even cover this. But there's a requirement under FinCEN, which is Financial Crimes Enforcement Network. Anybody that's familiar with FBARs or foreign bank account reporting, it's the same division. And you have to disclose if you have substantial control over an entity, basically able to make decisions, let's say you have control of the general partner or you have greater than 25% interest in the entity. There's a number of exceptions that apply, but they tend to be for larger businesses. So if you think of your funds or any entities that you've structured for trusts or small businesses that you might own, you're going to be subject to this most likely. The first reporting requirement starts January 1st, 2024, so just a few months from now. And the takeaway here is any new entity you form starting in 24, you have to report within 30 days. Any failures are subject to a penalty of $500 per day for a maximum of $10,000 per filing. And for existing entities, it's a little bit odd, but you have until January 1st, 2025. So any existing entity, you have an entire year to get that together, but any new ones that are formed in 24, it needs to be within 30 days. Once you file, you shouldn't have to file again unless there's changes in ownership. The changes that triggers different filers being reported as somebody with substantial control. So very important, check with your attorneys or other advisors that might help you with this. And then lastly, the IRS is definitely doing more audits of partnerships, and we're starting to see that come through.
My question to Alex to you is regarding the wash sale. So wash sale is only applied to the security, and digital assets are not security. Are they going to change?
So they've just talked about issuing guidance saying that cryptocurrency digital assets should be subject to this rule. That has not happened yet, and it's possible. You could see that along with other guidance being issued.
Couple more minutes, and we missed a couple of things. Let's see if we can go back and touch one of the things because of time consideration. One is the distribution of property, and there is contribution of the property.
Sure. Just in general here, with the few minutes that we have left, investment partnerships are great vehicles. They're very flexible in terms of putting investment assets in and taking them out without it triggering a tax consequence. S corporations and corporations, not the same. But in general, if you have a diversified portfolio of securities, you can contribute that to another existing diversified portfolio without it triggering a gain. Whatever unrealized that you have, you can carry in. There are ways to do it with things that are considered not diversified. So if you just imagine you had $1 million worth of Microsoft stock, you wanted to contribute that to a diversified fund that had 500 positions, that's going to be treated as a sale most likely, given those facts and circumstances. But if you had 20 securities in a brokerage account, you could do so without triggering that gain. If you do have one position and you're looking to put it into a partnership, you can do so as long as that partnership isn't yet diversified, meaning if you had one Microsoft position and it went into a fund that had, let's say it just owned Apple, you haven't really diversified yourself, meaning that you're still very concentrated, even though you now have 50% Microsoft and 50% Apple. That's not going to be treated as a gain. So you get to retain your holding period. Whenever you sell that position, you get, if it was 8 months and then it was sold 6 months later, you're going to get long term. You get to retain your cost basis. So it's a great tool. It creates a bit of an extra accounting, but it can be done. You can move to the next slide. Yeah, and then on the flip side, you can generally distribute securities tax-free. You're not limited to this rule of diversification. This is very helpful. If you have the ability to receive a security, you can continue to hold it, not recognize gain, to the extent that you wish to just keep it in your portfolio. It's not taxable to you. If anybody's familiar with the ability to donate appreciated securities, if you have securities that are long term already, and let's say you have a cost basis of 40,000, but it's worth 100, and it's held long term, you can contribute that to it. You can donate that to charity and get a $100,000 charitable contribution right off, even though you only have a basis of 40. So it's a fantastic planning tool. There's a number of rules here that talk about how the basis works, but typically you're going to be able to distribute all your securities if it's done so in a structured way, without triggering a gain and without having a gain or loss allocated to you that you shouldn't get. I think you're muted.
What is 734 basis adjustment? It's pretty common in most of that.
Sure. So let's see, so 734 basis adjustments occur if you sell a partnership interest or redeem and you recognize a loss outside the partnership greater than 250,000. There's going to be a mandatory basis adjustment within the partnership. So that's just something to keep an eye on. You sort of have to check with your tax advisor.
Okay. Awesome. I think it's almost we're done with an hour, and I think I would like to thank you, Alex. And
Sure.
any last minute advice to the fund managers if they're listening to the conversation?
I think just maintaining a good working relationship with your advisors and checking in on your end. And I've seen over the years a lot of surprises that happen for folks as they get into Q1 and they start doing their tax analysis. So just have a conversation prior to your end and make sure there's no surprises.
Thank you so much, Alex. I appreciate that. Unfortunately, whenever you log in, somehow I can't talk. So I let you speak the whole webinar, because whenever I talk, there's a noise coming towards me.
Okay, no problem.
Thank you so much.
Yep, take care.